Introducing Strategy Scans, the new and improved done-for-you market scanner. First off, what are systematic strategy scans and why should I care if I'm a trader or investor looking for potential daily market opportunities? Strategy scans are a new and improved evolution to the traditional stock market scanner. You've probably visited sites like finviz.com, stockcharts.com, and others that give you the ability to scan for dozens of data points on hundreds or thousands of stocks that meet specific criteria. The criteria might be based on such things as volume, price, fundamentals, or even technical indicators. This is a good habit for those starting out and trying to be more systematic in their decision-making processes, and these sites do a great job for many daily scanning needs. But these types of market scanners can be limited. Why? Well, because you don't really have any way of knowing what kind of results you might get if you decide to take any type of action on the scan list results they give you. A trader or investor has absolutely no idea if the scan that they have created has any type of edge whatsoever. Not so with our systematic strategy scans. Strategy scans both simplify and also take traditional scanning a big step further. How? By scanning for potential stocks after each market close that meet actual trading or investing strategy criteria and then that can be acted on the very next day. With current normal market scanning, you really have no way of knowing how good or effective the scans are. You have no real data that tells you what kind of results you might be able to achieve by taking any kind of action. So although many scanning tools and software available out there look really cool, you're still pretty much shooting in the dark. But not so with Systematic Investors Group strategy scans. The SIG community and a strategy developer have taken many hours, oftentimes countless hours, to research and develop a list of trading or investing rules along with all of the moving parts that are required to create a total turnkey trading or investing system. The results displayed are for recent stock strategy scans that have triggered based on this complete quantified investing system. That's right, the simple list of candidates displayed are based on the full backtested and quantified strategy, taking into consideration the investable universe of stocks, the entry rules, exit rules, position sizing, money management, and all the moving parts needed for a robust and turnkey strategy. In other words, stocks that meet the specific strategy rules and criteria are the stocks that show up in both buy and sell lists each day. Pretty much done for you stock scans, based on tested and quantified full trading and investing systems, not just one-sided scans. Please always remember that these results do not constitute advice of any kind. They are simply the output generated by computer models based on quantified and backtested models on past data and now the current market data. Read our disclaimers very carefully and remember that you, the user, are responsible for any decisions which you ultimately make with your own capital. Each strategy scan included at Systematic Investors Group has been put forth by the community and then developed by a system developer or team of strategy developers, computer coded, and then rigorously backtested, analyzed, and quantified going back to January the 1st, 2000, or the year indicated in the specific strategy scan. That's about 20 years worth of results data. This is important because any strategy can backtest well for a short period of time, 1 year, 2 years, or 3 years, but how has that strategy performed over a longer period of time that has seen different market conditions, environments, or entirely different market regimes? How did it perform during periods where bull market condition existed, and then perhaps bull market conditions did not exist? Or during very choppy years? Only a well-designed and implemented backtest using best practices and clean market data will expose this information properly and accurately so that you have a much better understanding of what to expect. Really important questions can be answered, such as what was the maximum drawdown and risk that this system experienced in the past 20 years? Or how many losers did this system experience in a row? All things that might better help you gauge, understand, and put some context around your potential risks going forward by what happened in the past. The two main components of the strategy scan are the latest daily scan list and the backtest results. Here you can see two separate and unique strategy scans In this example, one called the RSI2 pullback and the second called the supercharged momentum trend. A short description accompanies each strategy scan. Systematic Investors Group does not disclose the exact code used for the strategy scans to our members. However, all future pro-level strategy scans will include a full research write-up and details on the methodology or approach used in the models and the resulting research and backtesting results, so the strategies are not considered black box. It is important that users understand the basics of how these strategies work so that they can understand their potential strengths and weaknesses in different potential market environments. Users should spend some time understanding how to read the backtest results. Let's see what this looks like by clicking on the second or blue button in each respective category called View Backtest. At the time of this recording, the free strategies do not include the more in-depth research reports that will be included in future pro strategies located in the members area. A new web browser tab will open displaying this screen. The first tab of the backtest is called Backtest Assumptions. The Assumptions tab highlights some key information about the backtest. Because this is a historical simulation showing what might have happened if we started trading from the start date, in this case January the 1st, 2000, the selection of trading candidates and order of trades taking place will all be based on the assumption that we started with a specific amount of money at a specific time in the past and will have portfolio-based trading constraints placed on the test results. In other words, a portfolio backtest assumes that you are trading or investing using capital restraints, a specific start date, position sizing, and other restraints no different than if you were actually attempting to manage a real-world portfolio. You would also have real-world trading or investing constraints. We make this distinction simply because there are other types of backtests that can be performed. This type of backtest, the portfolio backtest, attempts to realistically simulate real-world trading or investing conditions. Let's start from the top. The date that the strategy scan started posting on, out of sample date, is essentially the date that the strategy was posted to the Systematic Investors Group website. Because this specific strategy used a full sample backtest, all of the data going forward will be out of sample data, or data that the backtest has not been tested against. Any of the data used to backtest the system is considered in-sample data. So the out of sample date starts, in this example, on November the 7th, 2019. Out of sample data could be considered how the system does going forward in real live conditions. Next, the test type, as mentioned, is a portfolio backtest. The trading universe used in this example is the NASDAQ 100, so our scans for this strategy scan will always look for opportunities within this specific index watch list. For our backtesting, note that we use delisted stocks for a more accurate backtest. This means that stocks that might have been trading in the NASDAQ 100 index in the past, but that now have been delisted for a number of reasons, would have been included as results of the backtest. This is important in order to get a much better and more accurate backtest result. The other important data consideration is that we are using, in this example, historical constituents of the NASDAQ 100 index. This helps us to avoid survivorship bias or testing against stocks that are in the index today that might not have been in the past, which may give us an inflated result. Again, a more accurate backtest result will be achieved because we've traded stocks that were actually part of the index in the past and have not assumed that only the stocks that have made it today are being tested as though they existed in the index in the past. This is quite important for backtesting accuracy. Thirdly, our data is properly adjusted for splits, dividends, and capital reconstructions, so we are working with properly adjusted data and data that is survivorship bias free. Our end-of-day data source is a professional level data feed that monitors and cleans the data and makes adjustments when data corrections are needed. For a real-world portfolio backtest, we are assuming a nice round number of 100,000 for starting capital. The max number of positions in the portfolio may be an optimized number that better tells us how many positions would be ideal to trade at one time in the portfolio. In this case, it's 15 total positions. This brings up an important point that requires a bit of discussion. We are big believers in portfolio-based trading and investing for a couple of important reasons. First, by trading portfolios of stocks for each strategy, we are diversifying our risk among many different positions instead of just one or two. This allows us to better our odds of success and reduce our odds of failure by having one big position that moves against us at any given time. By the law of large numbers, the more occurrences we can exploit, the closer we will move toward our expected edge. So it allows for some diversification and risk and money management. Portfolio backtesting and trading also reduces the chances that your model is overfit to the data. This is sometimes called curve fitting. A simple but effective way to position size and using money management is by using equal weight position sizing. In this case, if you take 100% of your positions and divide by 15 total positions, you will get 6.67% allocation per stock position. This brings up another interesting point. As the portfolio grows, so too will each position in terms of dollars invested because the percentage per portion remains the same. If the account shrinks, the same also holds true. This is naturally a good and effective money management technique. Because each broker commission rate is different, and we're seeing a race to the bottom recently with online stockbrokers in terms of commission rates, we've decided to just set commissions to zero for the backtests. Commission should be a consideration of costs in any trading plan, so this is something that each person can estimate based on the number of trades they might be taking. A good rule of thumb could be to account for 1 cent per share traded for both entry and exit, or 2 cents per round turn. You will see in the backtest results the total number of trades taken over the entire backtest period, so an average number of trades can be taken by taking the total number of trades and dividing by the total number of years to get the average number of trades per year. The start date used for this test is January the 1st, 2000. The end date states end of last current month. The reason for this is that each backtest will be updated at the end of each calendar month to reflect updates current to the last calendar month. This will give an indication of how the strategy is performing on the month-by-month basis, but keep in mind this one fact. The backtest is assuming the logical progression of trades that this portfolio would be taking based on its start date and whatever positions it might have had in its specific portfolio going into each month and how many slots it might have available to trade new positions from month to month. If you were to start a new trading or investing program at the start of each month or at any different time, the results, specific trades taken, and position sizing would all be different. So the backtest results going forward from any new start date would cause variation in the results. Stated another way, if you were to compare the trade list of this backtest at the end of November of 2019 and then start a new backtest or even a new live trading program starting from November the 1st, 2019 until the end of that same month in November, you will notice that there will be variations in the actual trades that might have taken place from one test to another. Because the portfolio backtest assumes that it will be taking the highest ranked symbols available each day, only if there is enough room in the portfolio and the portfolio has enough position slots available. It will also depend on the strategy rules of the system and whether there were available opportunities presented to act on. This hopefully should make logical sense. Let's jump to the Statistics tab now and into a more interactive demo to review the statistics and chart tabs of the backtest. Okay, so I've gone to the Systematic Investors Group website and I've actually logged in. So you'll need to be logged in order to access the strategy scans. Next, we'll go to the free daily strategy scans. And okay, we'll just navigate to the actual RSI2 pullback strategy and we will view the backtest results. So going to the Statistics tab, we can see here that here are the statistics that were generated for the backtest result. These are updated at the end of each calendar month. And we can see here for the RSI2 system strategy, we're starting with an initial capital of 100,000 in our backtest. This is our ending capital, just almost 1.85 million. And we can see this is the net profit. Now, if you want to see any of the descriptions of what these metrics are, you can just hover over them and it will a tooltip will come up and give you that information. So every system developer and every strategy analyzer will look at backtests a little bit differently depending on what their objective function or what is important to them in terms of what their risk tolerances are and what they're looking for in their actual for their actual trading plan and for the results that they're looking to get. So I'll go over some of the key things in here, just recognizing that everybody's a little bit different and people look at metrics and give importance to different metrics a little bit differently. So we can see here that the net profit that the system experienced was this number here, about 1,744. The exposure is 68%. So this is the amount of time that the system was in the market. So it was roughly 30% in cash. The net risk-adjusted return percentage was this number. The annual return on average was almost 16%, and that is an average. The risk-adjusted return is about 23%, so that is the return taking into consideration the amount of exposure that the system was in the market. Now you can see here we've got a good statistical sample size of 6,120 trades. So this is a good representation of we've kind of exploited the law of large numbers, and you can see there's enough trades here to be statistically relevant and in order to get us closer to our edge. So you can see here that the average profit and loss per trade was about 284. That's really less relevant because the size of the trades keep going up as the account grows. So what you really want to look at is this figure here, average profit divided by average loss percent, which is essentially your expectancy. So what this is saying is that you're making on average about 0.78% per trade between your winners and losers, and the average bars held for your trades is almost 10. It's just over 9. So in this case we had 3,715 winning trades, which was about 60% of our trades were winners. And if we look at our average profit per trade, that was about 4.71%. And our average bars held for our winning trades was about almost 9 bars per winning trade, so 9 days, because our days are essentially equal to bars. Our maximum number of consecutive winning trades was 33. So we had a string of winners of about 33 trades. The number of bars in our largest win was 3, so that was a pretty quick trade. Now if we look at our losers, we've got about 40% losers, and our average loss is about minus 5.29%. Now this system works because we're getting 60% winners and 40% losers on average. Now our maximum, this is an important figure here, our maximum consecutive bars in our losers is about 19. So what this means is at some point during the backtest there were about 19 consecutive losses. This is why it's extremely important as a systematic trader or investor to position size properly, because you can experience a string of losses, and if you trade too big of size, then you can blow out your account essentially. So the number of bars in the largest loss was about 19. If we look down to some of the other metrics, I won't cover them all, but some of the key ones that I specifically look at is I look at the maximum system percentage drawdown. So it was about 30%. So at some time in the history of this trading system, it experienced a peak to trough drawdown of about 30% of the total account equity. Now this is not uncommon for trading systems. All trading systems have drawdowns, and all trading systems go through winning periods and losing periods. And it's essential as a systematic trader to have the patience and to be able to understand when you're going through potential normal drawdown and when you're potentially, your system may be broken. In this case, the system wasn't broken over the years, but it did experience a 30% drawdown at one point in time. As opposed to the market in general, it has a better drawdown than the overall market. I think in 2008, the S&P had a drawdown of about 56%, and the NASDAQ had an even larger drawdown. So it definitely outperforms the market in all aspects. Now, if we look at the Another important metric, the CAR MDD, or sometimes this is referred to as the CAR over MDD, the CAR over the maximum drawdown. Sometimes it's referred to the MAR ratio. Now, it has a ratio of about 0.52%. So what this means is that if you take the compounded annual return, the average annual return, and you divide it by your maximum drawdown, you're getting about 0.52. This is around the area where we start getting interested in looking at trading systems because they have a definite edge in there and they perform quite decently. So we're at about 0.52 here, and what this means is that using averages, although averages aren't usually indicative of good years and bad years, but using averages, it would take about 2 years to recover your drawdown. Looking at it that way. So there's some other ratios in here. Profit factor, the profit of winners divided by the loss of losers. We have it at around 1.33. And then the payoff ratio, which is the ratio of the average win divided by the average loss, is about 0.86. Usually like to see this above 1, but since we have 60% winners versus 40% losers, this works. Now there are some other metrics here. Depending on how you like to look at trading systems, you can look into what these metrics means and how to interpret them. Again, the tooltips will come out, and we may post a video on the website that describes some of these other metrics. For the time being, we've covered the majority of things that would make sense in analyzing a system. So let's move forward to the actual charts. If you display this error when you load the charts, just hit refresh on your browser and then go back into charts, and you'll see here's the equity chart over the years. It's a pretty decent looking equity chart. There was a recent drawdown in about 2018, and we can see now the equity chart is actually hitting new equity highs, which is a good sign. And at the time of this recording, it's November the 25th, 2019. We are in the the seasonal period of the year where the market actually does well. So that's a good indication. Now you can see here's our drawdown chart, our underwater equity chart, and you can see what the average drawdowns look like, and then where we had some of the larger drawdowns as would be expected. The dot-com crash and the 2008 financial crisis were the areas where we had the largest drawdowns. But as you can see, all systems undergo normal drawdown, and in fact a lot of systems actually exist in drawdown a number of times, or rather often, and they only hit on average new equity highs maybe 10 or 15% of the time. So this is fairly normal for those that are familiar with systematic trading and investing. One of the things I like to look at is the profit table. So you can see here we've got all of the relevant years going back to 2000, and we can see the percentage profit per year. There was a couple of losing years. So you can see in 2000 there was a profit of almost 52%. In 2002 it was a losing year. 2008 was also a losing year. So as you can imagine, these were the years on your chart, on your drawdown chart, where you had your largest drawdowns, as would be expected. Now if you look at the recent performance, 2018 was a bit of a struggle. 2019, the backtest is updated until the end of October. As you can see here, November and December are showing NA, not applicable. We're up about 19.6% on this year. And if you look at the average, you can see what the average months over the almost 20 years of data is showing in terms of returns. You can see some months on average returned better than other months. October seems to be quite a standout month. So this is just a quick overview of what the backtest results look like. If you have any questions, certainly contact us through the contact page on our website, which you can locate here, and you can also send us an email at info@systematic-investors.com. Now let's have a look at the View Latest Daily Scan section by clicking on the green button. This will be the more active link that users will visit each day once they've assessed the backtest. A new window will open up showing something similar to this screen for each strategy scan. These lists are updated before the market open each day for each distinct strategy scan. Each distinct strategy scan is a self-contained, complete turnkey trading or investing strategy or system with the buy and sell rules as part of the model. We will sometimes refer to these as systems interchangeably with strategies since they encompass all of the moving parts of a complete system. On the left-hand side is a list of potential buy scan results, and on the right side is a list of potential sell results that are automatically generated from the model and posted to the site each day. These are posted several hours before the market opens and based on the closing data from the night before. So most of these models, unless otherwise stated, are end-of-day systems, and the data posted is valid from before the market open until the next morning. Each strategy scan shows what date and time the list was posted. Note that buy scan is ranked by a value from highest to lowest in the rank column. The ranking used is an algorithm that the strategy developer has decided upon and that ranks the opportunities from highest to lowest. This is important because if we have more signals than strategy position slots open in our portfolio, we need a way to rank the importance of which opportunity might be given precedence. Although the ranking is decided, of course, any user can override this and decide which, if any, might be suitable candidates based on their own discretion. For example, chart readers might like the look of one stock's chart over another stock's chart and use their own discretion to make ranking decision. Let's go over what each column means. The ticker column is the stock ticker symbol. For example, TSLA stands for Tesla. The date time column shows the signal date. Because most or all of our systems at this present time are end-of-day strategies, the list is generated early in the morning before market open, but based on the close of the day indicated by the date time. In other words, the opportunities for today are based on the close of the previous day. The list is actionable for the next trading day from the date time posted, which will be the current day when the user accesses the strategy scan list. Note that Friday closes won't necessarily have signal generation dates that show the day before the Monday for obvious reasons, so you'll want to pay particular attention to the date jumps between Friday and Monday morning. You also want to pay particular attention in case signals don't get generated on our site on any specific days, so beware of the date times and whether they are accurate and up to date or not. Technology problems can and do happen from time to time, and we do our best to make sure things are always up and running, but you'll want to make sure that you are dealing with the latest strategy scans. The rank column, as mentioned, is an algorithm that the strategy developer has chosen and backtested that ranks the priority of the list by most important to least important. The higher the rank number, the more important. There can be ties in values, in which case the ranking values should be considered equal. The action column, in this case BTO, stands for a potential buy to open. The order type column, in this case LMT, stands for limit price. In other words, for best potential backtest outcome, the model suggests a buy at the limit price or better. Some orders may specify MOO for market on open or MOC for market on close. This is all based on the strategy developer and their backtest results. The MOO and MOC orders won't specify limit or better than prices. Market on open orders are the market's opening prices at 9:30 Eastern Standard Time. Market on close orders have to be placed in the market before 3:45 Eastern Standard Time in order to be valid and usually correspond with most charting platforms' posted closing price for the day. The end of day auction that takes place and the MOC orders benefit from typically gives the closing price without the potential slippage caused using normal market orders, instead using MOC or market on close orders. The limit column, in this case since the strategy developer decided to use limit orders, specifies a limit price. The TIF column stands for time and force. This assumes day. In other words, if the order isn't filled by the end of the day, the order should be canceled. You will probably rarely, if ever, see GTC or good till cancel orders used, so most if not all strategy scans will generally be set today. The way that this information can be used should be fairly obvious. The user has a discretion at any time to decide what, if anything, they want to take action on for any particular strategy scan. Users should take the time to understand the risks associated with any potential market model as indicated from the backtest results. That being said, a good rule of thumb that we hear often is that your biggest drawdown is the one not yet experienced in the future. The backtest only shows what the historical data simulation has experienced, and anything can, may, and will happen in the future, so this always needs to be kept in mind. The cell scan on the right-hand side follows a similar format with a few obvious differences. Cell scans don't have any ranking because they assume that if the model has generated a potential cell and a cell condition in the model exists, there is no precedence of signals. Some strategies may show quite a few cells. The reason for this is that the cell conditions will show at any time that the cell signals might be active for the strategy model, whether a specific user has a cell signal or not. If there is no position currently in the user's portfolio, this would simply be ignored. It would not mean a short opportunity. This is important because different users may have different positions or no positions depending on when they started using the information and how they decided, if at all, to use the information. So all cell signals will be generated for those that require them. The columns follow the same logic essentially, by showing the ticker or stock name, the date time of the strategy scan, the action, in this case STC or sell to close, is what the model is outputting. Also the order type, in this case MOC or market on close. It doesn't make sense to use limit orders for cells since limits are not guaranteed fills, so cell scans will typically have MOC or MOO order types. Time in force is also day. You'll notice a note at the top of each scan mentioning Alera Portfolio Manager. Alera Portfolio Manager is a piece of software that some of us in the systematic investors community absolutely could not live without. Because many of our community members believe in diversifying through multiple trading or investing systems, it would be very difficult to manage multiple trading or investing systems and multiple data entry for each system every day. Alera Portfolio Manager is a great tool that allows users to pick up and process the information contained in these strategy scans directly from our website and enable the user to manage their respective portfolios and their own brokerage accounts. It can also be used to pick up signals generated on a user's local computer or cloud instance, in the case of a user running their own private or closed strategy models. APM is designed to streamline the process, making the entire process more efficient and consistent while reducing or eliminating order entry mistakes. The APM software allows users the discretion to run in semi-automated mode so that the user has full control over which tickers to process or whether to process any tickers for any strategies at all. It can also be set at the user's own choice to fully automated mode so that all model output suggestions are processed each and every day. If you want to know more about the Alera Portfolio Manager or APM software and how we specifically use this unique tool, send us an email at info@systematic-investors.com or check out the upcoming videos on this subject on our website. Remember, these strategy scans are updated each and every day that the market is open, so check in every day. We've offered a few free pro-level strategy scans for users to try and monitor each day. They can also be paper traded using the Alera Portfolio Manager for free for 3 months. At Systematic Investors Group, our community continues to develop and post new research and new strategy scans all the time in the Members Pro Scans area. We plan to continue to add to the strategy scan library as new ideas are developed and prove themselves. This is an ongoing focus at Systematic Investors Group. The main reason for this is that markets are always evolving and new ideas come to light. Another key reason is that all traders and investors are different. Not all strategies are good for all market participants. It is important for a systematic trader or investor to understand the results of the backtest and what type of results and risks that the backtest indicates, and for that systematic participant to understand whether a particular strategy meets their specific and unique objectives, risk tolerances, and risk profiles. This is key because all trading and investing systems go through periods of drawdowns and losses, every single system. If some guru out there ever tells you that their trading system never loses, they're basically lying. This is normal. So when using any type of strategy or system, it is important to understand the potential risks and to be comfortable with those risks. One of the ways that systematic investors and traders can better mitigate these risks of losses and drawdowns is to run multiple different strategies and using smaller position sizes within each that are as uncorrelated as possible in order to help smooth out equity curves. While one system may be struggling for a time, the other systems might be pulling the load and thereby helping to reduce drawdowns. Strategy diversification is something that we believe in at Systematic Investors Group and we'll be talking about quite a bit going forward. The look and feel of strategy scans may change from strategy scan model to strategy scan model from time to time to reflect the technology used to evaluate the underlying strategy. At Systematic Investors Group, we're not married to any one technology. Although we have our favorites, our strategy developers may opt to use different tools to evaluate different strategy models. We hope that this short presentation and webinar on our new strategy scans was helpful. If you have any questions, please contact us at info@systematic-investors.com or directly through the contact page on our website at www.systematic-investors.com. We're sure that you'll find this information useful. Thank you. Trading and investing contain significant financial risks. Please take a moment to pause and read through the disclaimers in this presentation and on our website at systematic-investors.com. Thank you.